Hi everyone, I'm Ricardo Gonçalves with SBS on the Money. From the SBS newsroom for this Friday, the 6th of November 2020, it is your daily 10-minute business and finance news wrap. Later, the RBA's latest upgrades for the economy, and will we see negative interest rates? I'll have more on that with Kunnen from St George. But first, to the Australian share market, which actually had a really good week. Its best week in four, up by 4.2% despite the US election. For the day, it rose 0.8% on the S&P ASX 200 at 6,190. The banks did well. Macquarie Group rose 2% despite a 32% fall in half-year profit. Gold hit a 6-week high, so gold stocks like Newcrest rose. It added 3.5%. BHP put on 1.2%. Of the best performers on the 200, the top performer was Tabcorp, up 16% on takeover speculation. News Corp also did well, increasing 14% on a lift in quarterly earnings, and a broker upgrade helped Treasury Wines up by 10%. So the volatility we were all expecting with the US election hasn't happened this week. Well, it hasn't happened yet. Why? I spoke to Martin Lakos from Macquarie Private Bank about that and much more. Martin, how do you explain the rise in the Australian share market despite the uncertainty surrounding the US presidential election this week?
It does appear, Ricardo, the markets are getting a little more comfortable with the prospect of a Biden presidency and administration, but with a Republican-held Senate, which basically means that some of the Trump administration's economic policies were likely to remain intact, but also it's likely the Democrats' administration will actually spend more in the economy in terms of the recovery. And hence we've seen a pretty solid rebound in markets.
Does it leave it to some major volatility in the coming weeks?
Well, potentially it depends how long it's going to take to get the result and whether that actually is protracted and contested. It's probably more likely that markets are going to be watching the impacts of COVID, particularly in Europe and the United States, because obviously we've now got shutdowns in the UK, in France and other parts of Europe. And what's the economic impact in regards to that? That's more likely to impact markets than now the election result, which seems a little more certain. But, let's not hold our breath on that one.
When Donald Trump was elected back in 2016, our share market rose 10% from election day to the end of 2016. Why? And what kind of path are we on now?
Well, it's interesting, back in 2016, in fact, the US markets fell initially on the Trump win in 2016. But markets very quickly realised that his policies, or administration's policies, were actually pro-growth. He was going to cut taxes, cut red tape and spend more money on infrastructure. And to some extent, he's very much delivered on those policies and promises. So that's to some extent been one of the reasons why stock markets have done so well since that 2016 election. Clearly, this is a slightly different environment. And although those policies remain intact and are likely to do so, there's nothing really new coming out of the Trump administration. It's actually more likely the prospect of additional monies being spent by the Biden administration. That's probably going to keep the markets going ahead. And secondly, we've got the US central bank continuing to reinforce that interest rates remain low, they're adding more stimulus, and once again, that's going to aid the US economic recovery. So we are looking for
no negative interest rates. So how does that affect the market, given low rates prompts investors to search for growth, so things like shares?
Look, there hasn't really been a strong view that the Reserve Bank would need to go to negative rates. But obviously this second cut is really trying to get confidence back, particularly in regards to the business and household spending. And of course, the combination with the fiscal spending by the government in their last of an improving economy into 2021 also. At the end of the day, we do think that we will see, or we are seeing, signs of that recovery. But there's absolutely no doubt the Reserve Bank clearly stating that interest rates are going to remain at these current levels for quite some time until inflation improves, does mean that growth assets such as shares and property are very much in favour in this low interest rate environment, and defensive assets such as cash, term deposits and bonds less so.
So what are you telling your clients right now?
Well, we've been holding back, really waiting for this result. Obviously, there's been an expectation of a high level of volatility leading up to the election, and that did emerge in September, but seemed to recover through October. So now, once we do get an actual result on the election, I think there'll be a higher level of confidence to start committing more monies back into share markets, largely because of what we've just talked about in terms of a low interest rate environment, and investors are being forced into the share market for looking for better returns on their cash holdings. And we certainly are incrementally going to be adding into the market once we have a clear result.
In terms of the market moves today, gold's doing pretty well. Why?
Gold has fallen from, I think back in August, or it was at 2050 an ounce. It fell below 1900 at one stage, so it has rebounded towards 1950. It's much of a factor of viewed as a safe haven through these period of volatility in regards to the election and COVID, but also the US dollar recently in the last few days has weakened off. We've seen that Aussie dollar rally from 70.50 US to 72.50, and that's right across the broad spectrum of currencies. And so a weak US dollar is positive for gold. And so we've seen gold stocks today rally somewhere between 3 and 6%.
Martin Lakos there from Macquarie Private Bank. Let's check in on the Reserve Bank statement on monetary policy, which was released today. The Reserve Bank upgrading its economic forecasts, lifting its 2020 GDP projection from -6% to -4%, and for the following year from an expansion of 4% to 6%, and that's as local economies continue to reopen and restrictions ease. Now, obviously, what drives the economy is employment, and the RBA's baseline has the unemployment rate peaking at just under 8% before easing to around 6% in 2022, but that's nowhere near the lows seen pre-pandemic. It does, however, see an upside scenario if there is additional progress of a treatment of the virus in the short term, with the unemployment rate coming down to about 5.5% by 2022. But if there's major outbreaks and restrictions return, the RBA says the jobless rate could blow out to around 9%. So for more on that, I spoke earlier with Hans Kunnen, senior economist at St. George. Hans, how does the RBA's economic forecasts compare with your own?
They're relatively similar. They might be a little more optimistic. A lot depends on the timing of the opening of the borders and when you get a vaccine. And I think they may have erred on the side of optimism, but within their two baseline and their worst case scenario, we're within their range, not markedly different. To us, they seem reasonable.
I guess the unpredictable nature of the virus, though, can greatly influence those assumptions. How so?
Oh, look, we could have a second or third wave in Australia. We're talking about opening borders, but that may not happen. Who knows what the health outcomes are going to be and how that's going to spread. So those sorts of things just affect the pace at which you can open an economy and get on with trade.
And so given that, right, what does it mean for the continued need for stimulus, whether that be in the form of the Reserve Bank or the government, in the context of those upside and downside risks the RBA has for unemployment?
It's put in place its strategy, and if things work out and we get the vaccine and the borders open, fine, then maybe no further stimulus is required. Although I do note that state budgets haven't all been released yet, and I think further stimulus will come from that. But it's basically, okay, here's the game plan. Let's see how it unfolds. At halftime, we might need to change our tactics somewhat. They are prepared to do that. Both the Reserve Bank and the federal government have said, look, we're prepared to adjust if needs be.
Now, the RBA used to hold inflation as a major target, right? Is it less important now?
It's not less important. It's just going nowhere at present. Unemployment has risen as the major target. It's people's lives. And that's what we care about at the end of the day, not an inflation number. It's people's livelihoods. And they're focusing on that. So, yes, the unemployment rate becomes the more important number. But you never discount inflation because it can raise its ugly head at some stage, but not quickly.
And it's said that negative interest rates are unlikely once again. But at what point does it become likely?
At the point where everybody else is at negative interest rates and our economy is still stuck. And that seems to be highly unlikely. That's unexpected. We're seeing recovery, and if you're seeing that, you don't need negative interest rates. It's as if things fell apart from here, and that's not Plan A.
Hans Kunnen there from St George Bank. And despite putting a floor on those interest rates and I guess the uncertain or the unconfirmed outcomes of the US presidential election, the Australian dollar surged this week, up by 3.5% against the US. It started the week at around 70 US, ending at about 72.5. For more on that, here's Stephen Innes from AXI.
Yeah, really what gives it's sort of confused the market a little bit because we had a super dovish RBA that came out and everyone thought, well, it's time to sell the Aussie. But really, I think what stands out here is the Aussie's resilience to international risk, both the US election and also the Brexit kerfuffle. I think what that's telling me is the market's really focusing on the growth narrative, particularly around COVID. Look, we're moving into the winter of despair in both Europe and US. However, we're COVID-free in Australia. And I think currency markets are looking for the clearest path to the growth narrative, and I think that is one of those paths that are definitely clear.
Stephen Innes there from AXI, and that is On the Money for this Friday, the 6th of November 2020, and for the week, I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at BusinessRicardo.
This On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.